If you deposit $100 at a bank, they have quite a few options about what to do with it. They can keep some portion of it in reserve and store it in their account at their regional branch of the Federal Reserve. Since the creation of the Fed, banks have actually been required to keep a certain percentage of all deposits in reserve, and that percentage, called the required reserve ratio, is set by the Fed. With the remaining amount from the deposit, the bank wants to make money for themselves, and they can do this by purchasing securities like treasury bills, other government-issued bonds, mortgage-backed securities, corporate bonds, or any other kind of security which pays interest to the holder. And of course, the bank can also identify its own opportunities to make loans to their customers, such as small business loans, car loans, mortgage loans, or whatever else they have in mind. The Federal Reserve interacts with this banking system using their legal power to print money to steer the economy towards targets set for inflation and unemployment. A growing economy needs the money supply to increase in tandem with economic growth, and the Fed makes this happen by printing money and using it to purchase securities from banks. Typically, the Fed has limited its purchases to T-bills, which are short-term government bonds. The banks are free to do whatever they like with the cash, and generally they use it to buy more securities and make more loans. But sometimes they also use their excess reserves to make loans to each other. The day-to-day business of a bank will see a lot of deposits and withdrawals, and to make sure they have enough cash to meet the reserve requirements of the Fed, a bank might need to borrow from another bank on the federal funds market. These interbank loans are freely negotiated between banks, but like any lending, the interest rate banks charge each other is determined by the market forces of supply and demand. The Federal Reserve can speed up or slow down its asset purchases in order to influence the supply of federal funds and therefore influence the interest rate charged on the federal funds market. The Fed sets a target rate for the federal funds rate, and they will use asset purchases to keep it within the range they believe is most consistent with their targets for inflation and unemployment. By influencing this rate, the Fed puts pressure on interest rates throughout the economy to adjust in the same direction, shifting aggregate demand to hit those inflation and unemployment targets. But during the recession in 2008 and 2009, the Fed ran into a problem. The economy was in such dire need of monetary stimulus that they pushed the federal funds rate down to zero, which is as low as it can go. They could keep buying assets, but the cash was just piling up in bank reserves and not being lent out. This chart shows the excess reserves banks were keeping. Prior to the Great Recession, banks only kept what was required in reserve. There was little reason to keep more. After all, money sitting in your reserves wasn't earning your bank any money. So banks were quick to use excess reserves to buy securities and make loans. In fact, in the 1990s, with the rise of computing technology, banks started writing computer programs which would transfer their funds into different accounts to essentially hide them from the Fed and keep less than the required reserve ratio dictated. But once the Fed hit that zero lower bound, their asset purchases started to stockpile in the banks. The banks weren't buying assets with them, and they weren't lending them out. So the Fed needed to try some new policies to get the economy running again. The Fed started purchasing different kinds of securities in a program called quantitative easing. The name isn't very descriptive, but it was a little different from their usual open market operations. Normally, the Fed would limit its purchases to T-bills, which are a short-term asset, and so the Fed really only influenced short-term interest rates like the federal funds rate. But with that at zero, they turned to purchasing other long-term assets like mortgage-backed securities, longer-term treasury securities, and even bonds issued by state and local governments. The goal with quantitative easing was to push long-term interest rates down as well, and also to target specific parts of the economy, like mortgages and local governments, where people were especially hard hit by the financial crisis. By pushing mortgage rates down, the Fed could help homeowners recover from falling housing prices by giving normal borrowers and borrowers in difficult positions the opportunity to refinance at the lower rate. In that way, the Fed could help Main Street, as they say, rather than just Wall Street. Of course, these excess reserves posed a problem for the Fed once the crisis was over. With these ample reserves, they would never be able to get the federal funds rate to go up. Normally, they would just sell assets back to banks, but here there was an enormous reservoir of cash, and the Fed wouldn't be able to sell fast enough to stop runaway inflation. So, in 2010, Congress revised the law governing the Fed to give them a new superpower. The Fed was now able to pay interest on the reserve balances banks kept at the Fed. This is a little counterintuitive. The Fed basically started paying banks interest on all that money they had, effectively giving them more money. But this actually lets them limit the money supply. If the Fed raises the interest rate they pay on these reserves, it suddenly becomes a better investment for banks to keep more cash in reserve rather than lending it out and letting it circulate in the economy. The higher interest rate paid on reserve balances draws money out of circulation and acts as a sort of floor for all interest rates, pushing them all up when the Fed raises it. This is how the Fed now tightens monetary policy and gets control of inflation. Indeed, after 2015, as the economy started to pick up again, the Fed was able to push up the federal funds rate to meet their increasing targets by raising that interest on reserves. This new framework has been highly effective and has allowed the Fed to impact interest rates more broadly throughout the economy. Of course, the financial panic also showed the need to maintain sufficient liquidity among investment banks as well. To do this, the Fed uses a different tool called repurchase agreements. These are a common financial tool many financial institutions use, and the Fed can basically jump right into that market. They create some money and use it to buy assets from an investment bank. But the agreement is that the bank will buy the assets back the next day, paying a little interest for the loan. With repurchase agreements, the Fed can make sure these investment banks have enough cash to meet their needs and can quickly liquidate assets for a day if they need to. And of course, if they still need cash the next day, they can do more repo agreements. If the Fed is tightening monetary policy instead, they can use reverse repurchase agreements to pull liquidity out of these banks and push up short-term interest rates. The Fed sells securities to the banks overnight and then buys them back the next day, basically reversing the process. After a decade of employing these new policies to help the economy recover from the Great Recession, the Fed announced in 2019 that they would be sticking to this new framework indefinitely. In fact, the whole idea of excess reserves has been discontinued. Prior to the Great Recession, the Fed operated under a limited reserves regime. They controlled monetary policy through open market operations and the required reserve ratio. With those two policies, they could control the amount of cash circulating and the money multiplier, thus giving them total control over the money supply. But in 2020, the Fed dropped the reserve requirement altogether. They just didn't need it. Banks now had ample reserves. So since the Great Recession, the Fed has operated under an ample reserves regime. They still use open market operations, but their primary tool for hitting their target for the federal funds rate now is the interest rate paid on reserve balances to banks. Together with repos and reverse repos, they steer the economy by focusing on interest rates rather than monetary aggregates. And so far, this has been an effective new regime at stabilizing the economy. While some other economies experienced dips in their economic activity in 2015 and 2019, the US managed to avoid a recession until the COVID-19 pandemic. Hopefully, they will keep avoiding more in the future.